Let's dive right into this explainer. We're going to master your audit and assurance fundamentals together. Ever wondered if you can actually prove a company's financial statements are, well, truly fair? It all starts with an assurance engagement. We're gathering solid evidence to build real user confidence. Reasonable assurance gives a positive opinion. Limited assurance? That just means we didn't spot anything wrong. Since inherent and control risks already exist, an auditor's only real power is controlling detection risk. To spot internal control gaps, we use the DIRT framework. Find the deficiency, then test it. We reduce risk by testing assertions. Think PIE for everyday transactions and CAR for year-end balances. Now, evidence is absolutely key here. It must be sufficient in quantity and totally appropriate in quality. Direct external evidence, like a bank confirmation, that is always going to be your absolute strongest asset. To get that high-quality evidence, you got to take action. Use powerful verbs like inspect, confirm, and recalculate. But what happens when management literally hands you a written statement confirming details about their business? These written reps are completely required. They document critical stuff, like fraud awareness and going concern. If management refuses, you've got to discuss it immediately, because that might modify your entire audit opinion. Now, there is one absolute golden rule you must remember about these written representations. Written representations are just management confirmations and can never replace actual substantive audit evidence. Download my paid AA notes. Ultimately, all your hard-won evidence culminates in that final audit opinion, from unmodified to a disclaimer. Always apply this logic to the real world. So, think you can spot the next big misstatement? Audit versus business risk. We're diving into the explosive truth about the absolute biggest mistake on the ACCA exam. Never write business risks when the examiner asks for audit risks. You will score 0 marks unless you link the risk directly to a specific financial statement balance and assertion. Grab my paid AA notes. Now, let's unpack exactly how you might be falling into this fatal trap. See, writing about a company losing money or customers, that's a broad business risk, and it literally scores 0. What the examiner actually wants is audit risk. Basically, what could cause a material misstatement in the financials. For the exact same scenario, broad business risks get 0 marks, but targeted financial risks, full marks every time. So, picking an assertion is absolutely crucial. Recent examiner reports heavily penalize you if that link is missing. Drop those commercial terms entirely. Replace fluff like damage to reputation with overstated to stay strictly financial. Next up, the response trap. Never write down management actions. Always state what the auditor will do. Memorize this foolproof 5-step formula. If you hit every single step, you're going to secure those full 2 marks. June 2026 is fast approaching. Are you going to apply this formula tonight and secure those 10 marks? Studying for the AAA exam? Let's talk about how auditors literally end up in jail. No joke. Your first instinct is probably to help them, right? But warning your client is a serious crime. Under the Proceeds of Crime Act, if you suspect money laundering, you absolutely have to report it. Keep an eye out for the big 3: placement, layering, and integration. That's how criminals hide cash. Spot any of those? You gotta file a suspicious activity report to your nominated officer right away. But here's the trap: tipping off. It is a massive criminal offense to warn your client. So don't say a word. You've got to report their shady activities in absolute, complete secret. Because failing to report or tipping them off means personal criminal liability. Yes, actual jail time. Want to master this for the exam? Grab my AA PDF notes today. Your freedom is worth it.
Tax avoidance gets you refunds, but tax evasion? Yeah, that literally gets you prison time.
It's a crazy contrast. One's just smart legal planning, and the other is a straight-up cry.
Here's the deal. Avoidance is totally legal. You're just using the rules to shrink that tax bill. Evasion, though, that's illegally hiding your income to dodge taxes. It's a massive legal offense. Right, so what does this actually look like for us in the real world? Popping money in an ISA? Totally legal avoidance. Secretly hiding cash sales? 100% illegal evasion.
You gotta know the difference. Go master ACCA tax right now with my PDF notes.
Welcome to this explainer. Today, we're tearing into the intense reality of corporate finance. We're going to look at how you can pull yourself out of that dreaded Big Four burnout machine and actually elevate your career to a strategic CFO mindset. So let's just dive right in, because honestly, this burnout machine, it's coming for almost everyone trying to climb the ladder.
Take a look at this quote, straight from the front lines of FP&A. It perfectly nails the sheer mental toll we're talking about. You know, the real stress in finance, it isn't the complex math. It's born from overpromising, terrible planning, and just the crushing weight of executive pressure. You've got analysts out there who are constantly forced to paint a complete masterpiece using totally incomplete information.
And that brings us to our archetype for today. Meet Michael. He is an exhausted senior accountant trapped deep inside this Big Four burnout machine. He totally believes that saying yes to absolutely everything is his only ticket to a promotion. So he's grinding out 80-hour weeks, taking on every single ad hoc request, basically acting as a human shock absorber for the whole company. But, well, eventually the human mind just hits a breaking point.
What's happening to Michael clinically is called cognitive depletion. Look, after 8 hours of work that demands deep concentration, your brain is just done. It's no longer in any condition to retain new info. So Michael's exhaustion, it's actually a systemic neurological failure. It is not a lack of willpower or hustle. When you're running on fumes like that, you literally cannot make safe, optimal judgments. Period.
Section 1. The risk of ruin, when exhaustion meets material risk.
So what happens when an analyst's brain is completely fried? They start relying on quick and dirty workarounds. Imagine the absolute terror of cranking out a super rushed, one-off report that you figure no one really cares about, only to find out later it was used as the foundation for a massive, high-stakes executive decision. Yeah, those unchecked assumptions can literally break a company.
And we've seen this exact, dangerous progression play out before, most famously in the Enron collapse. It always starts innocently enough, right? Just doing whatever it takes to make the numbers for Wall Street. But because nobody fixes the actual structural problems, these exhausted teams shift to managing the numbers. And eventually, reality totally decouples from capacity. It ends in outright fraud, literally making up the numbers, just because facing reality feels way too terrifying. Just look at this horrifying disconnect on the chart. Enron actually artificially raised its earnings estimates right before its complete and utter collapse. They completely ignored operational capacity just to appease the bosses, and it resulted in a devastating $60 billion, yes, with a B, billion-dollar loss. It is the absolute ultimate consequence of a toxic burnout culture.
Section 2. The CFO pivot, capacity management and boundaries.
Okay, so how do we fix this? We've got to shift away from being the anxiety-ridden order taker. You know, the guy Michael used to be, who just accepts every single request and relies on static budgets. Instead, we have to pivot to the strategic CFO mindset. This is a leader who manages capacity dynamically. They connect headcount directly to cash flow, which gives them the undeniable rock-solid leverage they need to push back.
To pull off this pivot, finance teams have got to get in line with 2026 leadership trends. You can't just sit there being the historian of your company anymore. Real success means you're anticipating liquidity risks, you're rolling out dynamic, driver-based planning, and you're actively guiding the business through uncertainty rather than just panicking and reacting to it after the fact.
Section 3. Shadowing for boardroom fluency, the dual iterative framework. All right, to actually establish these firm boundaries in the boardroom, we need to do some active linguistic practice. We are going to use what's called Phase 2 subtitled shadowing. So I want you to listen to my voice, read the text on the screen, and repeat these professional pushback phrases exactly as I say them. This bridges the gap between seeing the words and actually speaking them with authority. We're going to repeat each phrase exactly 2 times. Let's get into it. First up, please shadow me to practice deflecting a random ad hoc request professionally. If we prioritize this request, what other deliverable should we delay? If we prioritize this request, what other deliverable should we delay? Great. Next, shadow this phrase. This is going to buy you time and protect your model from those cognitive depletion errors we talked about. I need to verify these assumptions before we lock in the forecast. I need to verify these assumptions before we lock in the forecast.
Moving on. Let's practice disagreeing professionally while keeping the whole conversation strategic. The variance here suggests we need to revisit our core operational drivers.
Finally, let's shadow this crucial boundary-setting phrase. This is designed to stop those dangerous quick and dirty traps right in their tracks.
To ensure accuracy for a major decision, we need to apply the full scenario model. To ensure accuracy for a major decision, we need to apply the full scenario model.
Section 4. Elevating to the strategic storyteller. Now, by mastering those boundaries, you're actually buying yourself the mental bandwidth to finally elevate your career. The best CFOs, they do not drown their executives in massive, confusing spreadsheets. Nobody wants that. Instead, they leverage a real storytelling toolkit. We're talking hard-hitting visuals, interactive dashboards, and real-time data to present a nuanced, compelling narrative that actually drives alignment across the board.
This quote really hits the nail on the head. Your ultimate value to an organization is not exhausting yourself with infinite ad hoc tasks until your brain literally stops functioning. The true role of the modern CFO is leading through all that complexity with a clear, engaging story. That, right there, is how you produce a truly lasting impact.
As we wrap up this explainer, I want to leave you with one final, provocative question to really chew on. Are you just reporting the numbers, or are you actually protecting the business? Think about Michael's journey. It's time to establish your boundaries, plan your next strategic move, and take back control of your career. Catch you next time.
Let's get right into it. The Big Four will work you to death if you let them. Working 80-hour weeks during busy season is not a badge of honor, guys. It destroys your mental health. You see, cognitive depletion isn't just about lacking willpower. It's actually a harsh, physical, neurological reality. Finance panic attacks stem from a nasty mix: overpromising, missing data, and insanely intense executive pressure. As one pro put it, dealing with executives often feels exactly like babysitting a natural disaster. All this intense pressure leads to cognitive depletion. It completely destroys your analytical judgment. And that pressure quickly turns toxic. You go from managing expectations to straight up making up the numbers. Enron is the ultimate warning here. They started by desperately managing expectations and artificially raising earnings. But that underlying problem was never actually fixed. Their stock began to slide as deception caught up. The result? A devastating collapse. Unchecked pressure destroyed the company, costing a staggering $60 billion. You must use capacity management and strategic pushback to protect your career from the burnout machine. Forget the stereotype. Modern finance survival totally requires soft skills, relationship building, and really strategic communication. Ditch the silos. Use integrated business planning and start asking, if we do this, what breaks? The real secret? Please don't just dump raw data on executives. Tell them a compelling financial story. Use the bottom line upfront technique. Give them conclusions immediately to drastically reduce that ad hoc panic. State your insight first, then the background data. This builds persuasion and strictly secures your personal boundaries. Using these exact frameworks acts as strategic pushback, keeping you safe from becoming a burnout casualty. Build consistent boundaries and master emotional intelligence. Also, grab my paid notes to survive your finance career. So, will you let the machine dictate your breaking point, or finally take control of your story? Okay, so you've crunched all the numbers, and your spreadsheet is an absolute masterpiece of formulas. But the second you present it to the board, their eyes just completely glaze over. We've all been there, right? Well, in this explainer, we're going to fix exactly that. We're combining some cutting-edge AI prompt frameworks with the age-old power of narrative storytelling to completely change how you present data. Picture this. It's 2 a.m. You're an overworked FP&A analyst, literally drowning in a budget waterfall chart, and you're just trying to figure out how to explain a $50,000 variance without putting your entire executive team to sleep. I mean, the reality is that traditional financial planning and analysis kind of leaves us trapped in the weeds of data collection. But your true value to the company isn't in formatting cells. It's in guiding the business through uncertainty. And this right here perfectly illustrates the massive difference between robotic, jargon-heavy reporting and a clear, punchy narrative. Look, a classic data dump just expects the audience to connect the dots themselves. But a narrative-driven sentence, it immediately tells them the why. Research actually shows that human brains process information thousands of times faster when it's framed as a story. A wall of numbers fades super quickly, but a story with a clear cause and effect, that sticks for sure. So you might be wondering, how do we actually get from raw data to a compelling story without spending hours agonizing over commentary? Well, by utilizing a structured context, reasoning, output AI prompt framework, you can completely automate this translation. And honestly, here's the best part. You can save over 5 hours a week doing it. First, you just give the AI your raw context, which is your data table. Then, you provide the reasoning, just simple bullet points on the operational realities. Finally, you define the output, telling the AI to format it specifically for a CFO or board member. You basically become the strategic editor, letting the AI do all the heavy lifting of that initial draft. Now, this is where the Bridge to Budget AI prompt really shines. It's an absolute game changer because it tackles the hardest task in F&PA, explaining really complex variances to audiences who don't speak finance. As we know, a waterfall chart is notoriously tricky to verbalize, but by running your data through the framework we just talked about and explicitly asking the AI to bridge the budget, you transform this highly technical, multi-step reconciliation into a linear, human-centric story about exactly where the money went and why. Okay, but AI is really only half the battle, right? To truly elevate your presentation to that CFO level, your delivery needs structure. Step 1 is bluff. Bottom line up front. Don't build up to the big reveal. Give them the answer immediately and then support it with the evidence. Step 2 is the rule of 3. You've got to group your insights into 3 key takeaways so they're actually memorable. And step 3, which is probably the most crucial one, is ditching the technical jargon. Let's look at a real example of this. The goal is actively replacing dense financial terminology with plain, cinematic English to create an emotional connection with your stakeholders. Saying you have EBITDA margin compression might make you sound incredibly smart, but to a non-finance executive, it just creates instant cognitive friction. On the other hand, saying our profit per dollar of sales is going down paints an immediate, tangible picture. It perfectly bridges the gap between abstract numbers and the everyday reality of the business. Think about a clear, perfectly balanced cup of coffee. That's exactly how your financial communication needs to be, easily digestible, highlighting the human element behind the numbers. Analogies and visual metaphors like this are incredibly powerful tools. When you use them, you instantly reduce the intimidation factor of financial metrics. You want your audience to feel energized and clear-headed after you present, not totally bogged down by the sludge. Now, to help build that executive presence and automaticity, we're going to do a quick English shadowing practice. Think of shadowing as being a vocal echo. We're focusing on the rhythm, the stress, and the intonation. For financial professionals, whether you're a native speaker trying to project more authority or an ESL learner mastering business English, this builds the exact muscle memory you need to speak without any hesitation in the boardroom. So let's jump in, listen closely to this phrase, and then read it aloud with me. We are going to repeat it exactly 2 times to really lock in that rhythm. Ready? Instead of numbers, tell a story. Instead of numbers, tell a story. Great job. Now let's practice replacing that jargon we talked about. Listen, pause, and repeat exactly 2 times to really feel the cadence of plain English. Our profit per dollar of sales is going down. Our profit per dollar of sales is going down. Excellent. All right, finally, let's lock in the single most important rule of business communication. Channel that boardroom confidence and repeat this exactly 2 times. Start with the bottom line. Start with the bottom line. Fantastic work. Seriously, by mastering these AI prompts and shadowing techniques, you stop being a mere reporter of numbers and you evolve into a real strategic driver for your organization. When we look at the trends shaping finance today, it is all about integrating business planning. You're moving from a reactive function to a proactive one. AI can handle the data dumping and auto-generate those variance explanations, but it's your human judgment, your business acumen, and your narrative storytelling that will actually guide the company through volatility and risk. AI is your co-pilot, but you are the storyteller. As we wrap up this explainer, I want to challenge you. Apply this bridge to budget framework in your very next presentation. Start with the bottom line, cut the jargon, and just watch how it transforms your influence in the room. The numbers are just the raw materials. The narrative is what actually gets built. So the question is, will you keep just formatting data, or will you let AI build the bridge so you can finally lead with the story? Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Explain literally any budget miss in exactly 10 seconds. Explaining a complex budget bridge is definitely the hardest FP&A task out there. Because your non-finance boss will never understand your messy waterfall chart. But here's the catch. Just use my Bridge to Budget AI prompt to automatically turn all that messy data into a perfect executive story. Grab my paid AI finance prompts to pass. So, will AI replace financial reporting entirely?
Let's dive into advanced performance management and a massive corporate headache, the budgetary slack trap. Never accept a manager's budget without question. Have you ever padded numbers to easily hit your targets? Budgetary slack is when managers deliberately overestimate costs to create a hidden safety cushion and hit their bonuses.
The problem? This sneaky padding hides actual capacity and completely wrecks your efficient resource allocation.
It all comes back to the agency problem. Managers prioritizing personal payouts over the company's long-term health. You see, managers often live in fear of severe budget cuts if they hit their targets too easily. This paranoia drives wild, dysfunctional behaviors, like recklessly hoarding leftover funds at year-end just to keep them.
So, how does this happen? Well, the specific budgeting style your company chooses heavily influences this padding.
Bottom-up, participative budgeting boosts team commitment, sure, but it gives managers the perfect chance to build slack.
Imposed, top-down budgets fix this by drastically reducing that slack, but they can completely crush staff morale.
How do we actually catch it? Start by comparing actuals to industry benchmarks and running rigorous post-audits.
Another powerful weapon is zero-based budgeting. It forces managers to justify literally every single expense from scratch.
Yes, it is incredibly time-consuming to do, but it's a guaranteed way to eliminate hidden capacity entirely.
Alternatively, activity-based budgeting links costs directly to specific actions, completely dodging those sneaky, padded incremental increases.
But what if we just blew up the system and abandoned traditional, fixed annual budgets altogether? Enter Beyond Budgeting. It's a total paradigm shift relying on adaptive rolling forecasts instead of rigid contracts.
Ditching those fixed targets completely destroys the political gaming and naturally fuels a culture of continuous improvement.
Could abandoning fixed budgets cure the slack trap for good? Find out and grab my paid APM notes. Meet the 90-year-old billionaire who absolutely refuses to day trade.
While others panic and gamble, Warren Buffett built an absolute empire through pure patience.
But in the corporate boardroom, you must master a few key concepts to succeed.
First up, intrinsic value. What's a company actually worth, totally ignoring its current stock price?
Next, share repurchases. When a company buys back cheap stock, continuing shareholders mathematically win.
And the cash fortress strategy. Holding massive cash reserves helps achieve real long-term growth. So, are you investing or gambling? Grab my paid finance notes to pass.
Welcome to this FM Explainer. Look, it's super frustrating, but limited cash completely ruins positive NPV projects. So how do you actually choose? You've got all these amazing investment opportunities, but literally not enough money. We call this strict capital rationing. Basically, you just can't afford every single good project out there. The ultimate fix? The profitability index. Just divide your total NPV by that initial investment. Easy, right?
Let's see it in action. Faced with Project A or Project B here, which one gets funded first?
Here's the catch. Always pick the highest index first to maximize wealth. Grab my paid FM notes to pass.
Welcome. Today, we're doing a corporate autopsy on how massive financial empires completely fall apart.
Seriously, why do unstoppable giants, from Enron to FTX, just implode literally overnight? Let's look.
It's a loop. The dot-com crash, Enron, 2008, and right up to recent crypto meltdowns.
The fatal flaw? We're practically brainwashed to chase yield, blinding us to massive, glaring risks.
It all starts with the agency problem. That's when greedy managers prioritize their pockets over yours.
We hear myths about smartest guys in the room. The reality? Total breakdown in corporate governance.
Enron used crazy smoke and mirrors. They created complex shadow entities called raptors just to hide massive debt.
The fallout? Boom. $60 billion wiped out, destroying thousands of jobs and pensions instantly. Fast forward to today. Enron's sham hedges look exactly like the disastrous accounting behind FTX's collapse. Platforms like FTX promised risk-free yields, but they hid the truth. You could lose everything overnight. Your deposits were secretly recycled into crazy unsecured loans to places like Alameda, sparking massive contagion.
So where were the watchdogs? How do massive technical audit failures keep happening right under their noses?
Well, Enron's auditor actually helped design the fraud. Talk about a colossal, fatal conflict of interest.
Another huge trap? Confusing everyday business struggles with actual hard audit risks, like heavily overstated assets.
Normal audits only sample data. To catch a deep rot like FTX, you absolutely need forensic audits.
Zero accountability. When things go south, a total lack of disclosures leaves everyday investors holding the bag. Real protection needs independent directors, strict oversight, and a strong, unwavering ethical tone at the top.
And hey, in crypto, the only bulletproof defense against platform bankruptcy is straight-up self-custody.
Risk-free yield is a total myth. If your money isn't in your hands, who's actually profiting?
All right, the absolute biggest reason students fail this exam? Mixing up audit risk with internal controls. See, audit risk means getting your opinion wrong. A control deficiency, that's just a broken company process. So, to absolutely nail this and guarantee full marks, we use the DIRT framework. It's a lifesaver. It builds the perfect answer, right in order: deficiency, implication, recommendation, and then your test of control. First up, clearly state what went wrong. For example, there's zero authorization for purchases. That's your deficiency. After explaining the risk of theft, state the fix, like require manager approval for purchases over £500. Finally, test it using a strong active verb. Literally just say, inspect sample purchase orders for approval signatures. Don't make this rookie mistake on exam day, guys. Download my complete audit study notes right now. Welcome to the Explainer. I want you to picture the high-stakes, ridiculously high-pressure corporate boardroom of the late 1990s. The air is just thick with ambition. The numbers are absolutely dizzying, and the margin for error is literally zero. Today, we're going to step into the shoes of a chief financial officer to try and untangle one of the most spectacular corporate collapses in American history. Yep, we're talking about the Enron scandal. But we aren't just going to look at the numbers, and we're definitely not just gossiping about the executives. Instead, we're going to explore all this through what's called a dual iterative framework. That basically means we're looking at both the human narrative and the hard data to fundamentally change how we understand corporate governance. Let's dive right in. So here is our roadmap for today. First up, Iteration A, where we'll unpack the human drama and the company's culture of arrogance. Then we pivot to Iteration B, Forensic Accounting. That's where we'll really break down the raptor hedges, look closely at auditor conflicts of interest, and finally wrap up with some absolutely crucial governance and transparency lessons. All right, let's jump right into Iteration A, the human drama. You know, before a company's financials actually fail, its culture usually breaks down first. Our sources frame Enron's history so perfectly here. They call it a tragicomic story about deeply flawed people undone by their own arrogance and greed. And it started right at the top. You had Chairman Ken Lay, a guy who built this massive, glossy public image, always hobnobbing with political elites, but who was famously terrified of internal conflict. Alongside him, you had CEO Jeff Skilling. Skilling brought this incredibly brash, charismatic, and fiercely competitive style that totally remade the company. I mean, the guy was brilliant, sure, but he was also the kind of executive who proudly declared his own genius during a Harvard Business School interview. That kind of overwhelming hubris just trickled down, creating a toxic environment where asking basic, fundamental questions was treated as a sign of weakness. And when that kind of unchecked ego takes the wheel, the human consequences are, well, devastating. To really lock this critical concept into our memory, let's practice our shadowing. Say this core takeaway with me. Charismatic leaders induced blind obedience, creating a culture of corruption. Charismatic leaders induced blind obedience, creating a culture of corruption. So that begs the big question, right? How exactly did all that charismatic leadership mask a company that was fundamentally unstable? Well, the answer lies in the culture they engineered. Enron promoted a super competitive, cutthroat environment. They used this brutal employee review system that heavily rewarded aggressive dealmakers who, frankly, had absolutely zero real managerial experience. Meanwhile, Ken Lay's vanity and his desperate need to avoid unpleasant realities meant that as long as the stock price was ticking up, nobody wanted to look under the hood. They were basically selling a mirage of constant innovation to Wall Street, and that mirage became a mask that covered up massive, exponentially growing operational failures.
To really master financial communication, you kind of have to learn how to translate corporate gossip into technical reality. So the narrative expression is pretty simple. They were hiding debt in secret partnerships. But the forensic expression for that exact same action, that's off-balance sheet prepay transactions. Bridging these two expressions is what gives you the actual authority to audit the real story.
And that brings us smoothly right into iteration B, forensic accounting. Okay, let's shift our perspective away from the executive suites and get down into the precise, highly regulated, and honestly fascinating world of financial forensics. Central to Enron's whole deception were special purpose entities, or SPEs, and the infamous Raptor hedges. These were incredibly complex, off-balance sheet financial vehicles engineered by Chief Financial Officer Andrew Fastow. By 1999, Enron was booking these massive, unrealized gains on super volatile tech investments. Fastow used these SPEs to purportedly hedge against those investments losing value. But in reality, he was just exploiting the ambiguity of an internal marketplace. This allowed Enron to essentially defer reporting its massive losses and keep its earnings looking artificially robust to the general public. Investigators later straight up called these sham transactions. Just look at the prepays for a second. Enron didn't just stumble into these numbers by accident. The amounts they borrowed using these prepay structures were finely tuned every single quarter, specifically to meet Wall Street's expectations. Enron's executives would sit down, figure out the operating cash flow target they needed to hit, project whatever shortfall they had as the quarter ended, and then use these prepay transactions, which were, let's be real, just disguised loans, to artificially fill the gap. Between 1997 and 2001, they generated over $5 billion this way. No way that's an accident. But here's the really wild part. The math of the Raptors had a fatal flaw, which is perfectly captured in this finding from the Investigative Powers Report. I'll just read it. These hedges were not real economic hedges. Enron was entering into hedging contracts with entities backed solely with its own stock. I mean, think about the total absurdity of that for a second. A true hedge requires an independent third party to actually take on some risk. But Enron, they were effectively hedging against a drop in their own stock price using entities that were capitalized by their own stock. It's like a snake eating its own tail. When Enron's stock eventually started falling, those SPEs obviously couldn't meet their obligations and the entire house of cards just collapsed. Let's look at just how deep this rabbit hole really went. An SEC document detailing the Cuiabá power project in Brazil shows Enron wanted to take this asset off its balance sheet, a process called deconsolidation. So what do? They sell an interest to a related party called LJM1, which was controlled by none other than Enron's own CFO, Andrew Fastow. But here is the real kicker. They made a secret oral side agreement guaranteeing LJM1 would never lose a dime. Under accounting rules, if the seller doesn't transfer the true risk of ownership, you absolutely cannot deconsolidate the asset. This secret handshake completely violated the rules of risk transfer, rendering the entire accounting setup functionally fraudulent from day one. So you're probably wondering, where were the adults in the room? Why didn't anyone stop this? Well, the answer is a catastrophic failure of the gatekeepers. Enron's auditor, Arthur Anderson, had a massive conflict of interest. They were providing highly lucrative consulting services to help Enron design these very LJM and Raptor structures, while simultaneously acting as the independent auditor meant to, police those exact same structures. This integrated audit approach created a huge disconnect between accounting compliance and economic reality. Combine that with lawyers who totally blurred the lines between offering legal advice and facilitating misconduct, plus a passive board of directors who rarely question management, and you get a total systemic breakdown in governance. The inevitable result of all this wasn't just numbers on a page, it was the cancellation of thousands of real jobs and the total evaporation of people's pensions. The unwinding of these toxic structures led to a staggering $60 billion loss in market capitalization. This is a forensic reality we really need to cement. Let's do some shadowing here. Repeat this with me. Enron faced significant financial difficulties systematically masked by deceptive accounting tricks. Enron faced significant financial difficulties systematically masked by deceptive accounting tricks. Ultimately, the justice system had the final word on the whole shebang. As Deputy Attorney General Paul McNulty stated, their efforts were protracted, deliberate, and dishonest. The root of the financial crime lay in the precise structuring of those off-balance sheet entities. Let's lock in this final core legal takeaway together with one last shadowing exercise. The lack of genuine outside equity at risk constituted intentional fraud. The lack of genuine outside equity at risk constituted intentional fraud. Which brings us to our final, somewhat provocative thought for today. We've looked at the arrogance and the ego. We've looked at the special purpose entities and the catastrophic auditor failures. So how does mastering both the human narrative and the technical forensics actually empower you to champion modern corporate governance? Because true executive-level fluency requires knowing that numbers never exist in a vacuum. They are created by real people, and they're driven by culture. When you can spot the human drama and dissect the forensic data at the same time, you aren't just reading history, you are equipping yourself to prevent it from ever repeating. Thanks so much for joining me on this explainer, and remember, always keep questioning the numbers. Let's dive right into this explainer and uncover the ultimate corporate governance exam trap, Enron. How exactly did the so-called smartest guys in the room fool literally everyone? Everyone blames the human drama, but the real issue? A total systemic governance breakdown. Writing about their charismatic arrogance is a guaranteed way to fail your governance exam. To pass, we've got to rip away that illusion of success and check the forensic data. In 2000, Enron reported a massive $979 million in net income. But get this, $966 million of that came from hidden special purpose entities. So an SPE is basically an off-balance sheet tool used to hide massive financial failures. Let's expose the most infamous ones. The Raptor hedges, designed by CFO Andy Fastow. They transferred assets and shuffled payments to create entirely phantom hedges out of thin air. The crazy part, Enron backed these entities with its own stock. They hedged with themselves. No true economic risk was ever transferred. It was completely fraudulent right from the start. This wasn't just a single flaw. It was a catastrophic failure across multiple governance pillars. CFO Fastow actually managed the very partnerships negotiating deals with Enron. That's a massive conflict. And the corruption spread. Enron's own auditors actively helped design these deceptive Raptor structures. Meanwhile, the board of directors was shockingly derelict, letting these convoluted schemes multiply totally unchecked. The Powers Report nailed it. These were never real economic hedges, just pure earnings manipulation. So skip the human drama. You need to master the mechanics of this systemic breakdown instead. If everyone missed this, could it happen today? Don't fail your exam, buy the notes now.
Welcome to this explainer. The smartest guys in the room destroyed a $60 billion company.
It's wild. They wiped out huge investments through totally dizzying, incredibly complex accounting fraud. XX, like Jeff Skilling, built a super aggressive culture. It was driven by pure, unchecked hubris.
Enron used secret Raptor hedges to hide massive debt off their balance sheet. It's mind-blowing.
So their weapon of choice? The Special Purpose Entity, or SPE. Basically, a trick to inflate profits.
Using these Raptor entities, they ran a rapid-fire shell game full of literal sham transactions.
Here's the crazy trap. They were actually hedging their financial risk using their own stock.
Yep, up to 97% of these secret entities were just Enron stock. So, zero real protection. They even disguised all that secretly borrowed debt to look like healthy operating cash flow.
They pulled this exact trick to secretly borrow over $5 billion, totally hiding it from investors.
And Wall Street? Completely blinded. Analysts couldn't see through these heavily falsified, overly complex reports.
When the truth finally dropped, the restated numbers proved those massive profits were literally just a mirage.
Look at 1997. They reported $105 million, but actually only made $9 million.
So how did this end up causing a systemic breakdown in governance right under everyone's noses?
Well, everything collapsed. We're talking negligent board oversight plus severe, totally unchecked auditor complicity.
The auditors basically looked the other way, letting Enron hide losses and totally abandoning the public.
Because those Raptor hedges relied entirely on Enron stock, when the stock crashed, the hedges instantly failed.
Management casually tried to brush off over $1 billion in losses. Obviously, the market panicked.
The stock crashed below $1, triggering the largest corporate bankruptcy in American history at the time.
If gatekeepers are compromised, who protects us? Grab my paid notes to learn more.
Hey, welcome to this explainer on the ACCA Ethics and Professional Skills module. Let's bridge that gap.
The EPSM is a mandatory interactive module that tests your ethical judgment and commercial awareness in real-world scenarios.
Grab my study notes. Let's completely decode this entire module together right now.
First, logistics. It's a one-time fee of £79. And the best part? Absolutely no resit charges.
You'll tackle 10 interactive units. We're talking everything from basic communication straight through to advanced data analytics.
Plus, it only takes 15 to 20 hours to finish, totally at your own self-paced speed.
Think of the EPSM like a bridge. It literally connects your academic theory right into professional practice.
It builds crucial skills top employers are begging for, like sharp commercial awareness, teamwork, and data analytics.
Financial analyst Daniel called it a great way to truly grasp the ethical behavior required of real professionals.
So, here's the million-dollar question. Why do so many stressed-out students actually put this off?
Imagine passing all 13 exams, but without the EPSM, you literally still cannot claim ACCA membership. Crazy! Taking it early isn't just a basic requirement. It is your absolute secret weapon for final exams.
The value here is undeniable. Specific units directly map to passing your SBL and SBR exams.
Seriously, students who fail SBL often deeply regret not completing the EPSM beforehand. Don't be them.
So, what's the strategic sweet spot? Start this module right midway through your applied skills exams.
Getting started is super easy. Just log into MyCCA, pay that fee, and dive into Unit 1.
The bridge is totally built. So, are you ready to cross it and finally claim your ACCA membership?
All right, let's jump straight into this explainer. We're tackling a totally crucial concept in financial accounting today.
Are you kind of sick of losing easy marks on your ACCA FA exams to hidden traps? Let's fix that.
See? Examiners absolutely love testing your caution. Will you spot the actual financial reality or just get tricked?
So it really boils down to prudence. That's the ultimate rule of caution, keeping financial reporting grounded.
The prudence concept states you must recognize losses immediately, but gains only when they are certain.
Here's the classic trap. Never paint a rosier picture. Don't overstate assets, and definitely don't understate liabilities.
Got a tricky scenario? Identify the transaction, then ask, is a gain certain or is a loss possible?
Seriously, applying this one fundamental rule of caution will safely guide you through nightmare financial statements.
So don't fall for it. Think like a real accountant. Apply that logic and pass confidently.
Want to crush this? Get my paid FA notes. Would you rather be pleasantly surprised or financially devastated?
Welcome to this explainer. Today, we're unpacking something pretty massive, the profound psychological weight of money. We're going to trace a fascinating and honestly, sometimes dark thread that connects your everyday personal debt all the way up to high-stakes corporate finance. We so often look at the economy as just cold, hard numbers on a page, but the reality? Financial markets are driven by intense, messy human emotion. So let's kick things off by defining a concept that is actively reshaping our markets right now. It's called financial nihilism. Essentially, this is the growing belief that the traditional, safe paths to financial stability are just fundamentally broken. I mean, think about it. When people look around and feel that slow and steady saving is basically a scam, especially as inflation eats their paychecks and buying a house feels completely out of reach, they're naturally pushed toward high-risk, highly speculative behaviors. To truly wrap our heads around this phenomenon, we have to ask a pivotal question. What on earth connects a stressed-out Gen Z retail investor, the systemic market chaos of the 2008 crash, and a chief financial officer's corporate spreadsheet? Well, the answer is that deeply personal financial stress inevitably scales up to trigger systemic market chaos. And more importantly, we really need to look at what corporate leaders and finance professionals can actually do to fix this broken culture. All right, moving to section 1. The shame spiral, the personal crisis of debt. Let's start at the micro level. Everyday financial instability traps people in a debilitating psychological cycle. Research out of Harvard Business School, led by John Joachimowicz, shows that a lack of cash doesn't just keep you from buying luxury items, it creates this intense daily stress. See, money provides agency, the ability to literally buy your way out of unforeseen bumps in the road. And without it, individuals often fall into what's known as a shame spiral. This is where they internalize systemic economic failures as their own personal faults, feeling entirely to blame for their lack of control. Just consider the dilemma facing Gen Z today. With average debt loads approaching $94,000, homeownership is increasingly viewed as completely unattainable. No way, right? Plus, there's this underlying cultural sting, the broken promise that an elite college degree would guarantee a comfortable, elevated status. When that doesn't materialize, traditional, slow and steady investing just feels incredibly futile. Which brings us to section 2, nihilism and the casino, escaping into speculation. When people feel completely locked out of the traditional economy, what happens? They turn the financial markets into a massive speculative casino. And historically speaking, manic speculation isn't new at all. Manias occur whenever there's a willingness to pay huge sums for something valued much, much lower intrinsically. We saw it with 17th century tulips, literally paying fortunes for flowers, all the way to the 1990s dot-com bubble, the 2008 housing crisis, and today's doom scrolling. Modern speculation manifests in prediction markets and meme stocks, where users often mistake hours of late-night internet scrolling for genuine market insight. Legendary investor Warren Buffett actually highlighted this exact quote from economist John Maynard Keynes during a shareholder meeting to warn us. The stock market is an incredible asset to humanity, right? It allows us to easily invest in the greatest businesses in the world. But as Keynes noted way back in 1936, the situation becomes incredibly serious and highly dangerous when enterprise becomes merely a bubble on a whirlpool of speculation. Basically, the market makes its money when people are doing foolish things with their cash. Now, some cultural observers impartially note that this volatile environment is further complicated by fears of what they call financial censorship. There's a growing conversation around the idea of cancel culture merging with finance, where access to traditional financial tools could theoretically be restricted based on cultural conformity. And regardless of where you stand on that issue, the fear alone drives people further away from traditional banking and much deeper into alternative, less regulated, and often far riskier financial networks. Now for Section 3, Institutionalizing the Risk, Corporate Hubris and Complexity. So, we've looked at the individual, but how does this whole casino mentality infiltrate corporate culture? Well, at Enron, executives like Jeff Skilling championed jargon like optionality and flexibility, literally stating that the entire purpose of the business was to gain alternatives, which, if we're being honest, is really just a fancy way of saying they wanted to shift focus away from reality. They abandoned physical assets, which they viewed as way too slow and expensive, in favor of highly complex, risk-laden financial derivatives. They completely decoupled from reality in pursuit of sheer financial speed. Moving right along to Section 4, the analyst's burden, caught in the middle. So who actually pays the price for this hubris? It's a finance professionals on the ground. Consider the core fears haunting the finance community today. Analysts face intense psychological pressures, from the anxiety of failing super expensive certification exams, to immense burnout, to the outright terror of financial planning and analysis, or FP&A. As one professional noted, dealing with executives trying to hit aggressive targets can feel like babysitting a natural disaster. Analysts are absolutely terrified of becoming the fall guy when those unrealistic forecasts inevitably miss the mark. And the pressure is just relentless. Deadlines are always ticking. Producing highly complex metrics like the weighted average cost of capital or free cash flow pushes people to the absolute brink. A quick, dirty, one-off analysis can suddenly be used for a major strategic decision. This kind of toxic corporate culture leads to very real mental health emergencies, including panic attacks, for the very people tasked with managing the data. Finally, let's look at Section 5, Emotional Finance and Empathy, Bridging the Gap. To fix this massive disconnect, we desperately need a jargon translation. Emotional finance recognizes that financial choices are deeply personal and tied directly to our feelings. For corporate leaders to bridge this gap, they have to abandon cold, isolating terms. So instead of saying something like EBITDA margin compression, just say, our profit per dollar of sales is going down. Instead of citing a high debt-to-equity ratio, explain it as carrying 2 backpacks instead of 1. It immediately makes it human. By leaning into empathetic storytelling techniques, executives have this incredible opportunity to humanize complex data. This means using real-life anecdotes and focusing heavily on the actual human impact of financial decisions. When finance leaders actively do this, they stop being viewed as adversarial number crunchers who just steamroll operations. Instead, they transform their finance teams into truly collaborative, trusted business partners who drive positive change. It's a real game changer. Ultimately, bringing empathy back into the world of finance, both personal and corporate, means recognizing a fundamental human need. As Harvard's John Jachimowicz notes, whether someone is an over-leveraged Gen Z retail investor trying to escape a shame spiral or a stressed-out FP&A analyst just trying to survive a toxic close cycle, everyone needs a sense of agency and control. We absolutely have to structure our financial institutions to empower people, not just extract from them. So, I want to leave you with this final thought to chew on about your own role in the financial ecosystem, whether you're managing your own household budget or a massive multinational corporate portfolio. Are you just blindly reporting the numbers, or are you telling a story that empowers? Thank you so much for joining me for this explainer. Next time you open up a spreadsheet, take a second and ask yourself, what story is this data really trying to tell me? Okay, let's dive into this. Welcome to today's Explainer, where we're tackling an absolutely critical transformation that honestly every finance professional eventually has to make. We're talking about elevating your communication from just, everyday number crunching to true executive level persuasion. We're going to explore how you can take raw data, turn it into a completely compelling narrative, shift your boardroom vocabulary, and build the kind of bulletproof speaking confidence that gets your ideas a resounding yes. To really understand why this matters so much, let's picture a cinematic but sadly all too common scenario. Imagine a junior analyst. They've spent all night literally bleeding over their keyboard, building this brilliant financial model. But as they walk into the boardroom to present, the nerves hit. They rely on weak, hedging language, saying things like, well, I think this is profitable. Or worse, they hide behind dense jargon like, we had an accrual true-up. And what happens? You can guess it. The board just tunes out. The actual business context gets completely buried in the jargon, and ultimately, the proposal gets flatly rejected, canceled. The numbers were 100% right, but the story failed. So, to fix this, we need to master the boardroom vocabulary shift, moving from jargon to executive authority. This is where we introduce the dual iterative framework to shift your paradigm from just dumping data onto a table to crafting a real, authoritative CFO-level narrative. Now, what's really interesting about this slide is the stark contrast in how information lands. On the left, we've got classic technical jargon, EBITDA margin compressed 120 basis points. Look, to a non-finance stakeholder, this is incredibly isolating. It creates distance. They're probably going to tune out rather than admit they don't know what it means. But if you reframe it into plain language on the right, profit per dollar of sales is shrinking. Boom. It directly hits a business concern. It's clear, it's urgent, and everyone in the room instantly understands what's at stake. And here's another brilliant example of that shift. Instead of saying, we missed our forecast due to an accrual true-up, listen to how an executive would translate that. Last month's estimate was higher than actuals. Right? Because executives and department leaders rarely make their moves based on accounting mechanics. They need you to translate that technical accounting into clear business implications. When you do that, you're actually helping them focus on what matters and what steps to take next. One of the absolute best ways to make this shift is by using visual metaphors. It's like translating abstract jargon into a tangible reality. Instead of citing a high debt-to-equity ratio, tell the board, look, we're carrying 2 backpacks instead of 1, and that extra weight is limiting our movement. Instead of OPEX optimization, just say, we're making our day-to-day operations more efficient. And liquidity position, that's simply the size of our emergency fund. You aren't dumbing the data down at all. You're just making it relatable and memorable for a non-finance audience. All right, moving on to Section 2, storytelling with financial data, structuring the narrative. We're going to look at how to use the classic hero's journey framework to deeply engage the room and provide that crucial context. So how do we actually structure this FP&A storytelling methodology in real life? It really comes down to 3 key steps. Step 1, bluff, which stands for bottom line up front. Lead with the headline. Don't drag the room through your spreadsheet analysis step by step just to reveal the grand conclusion at the end. Give it to them right away. Step 2, use the rule of 3. Group your findings or risks into 3s because psychologically it's just so much easier for people to remember. And step 3, always end with a call to action. Tell the audience exactly what they need to do with the information you just gave them. If you take away literally just one concept from this entire explainer, please let it be this. Answer the so what before anyone even has the chance to ask it. When you connect your financial insights directly to your stakeholders' specific priorities and goals, you're proving that you actually understand their world. Strong data storytelling builds massive trust. It shows you're not just a number cruncher in the back office. You are a strategic partner. Now, knowing the right words is only half the battle. Delivering them with real authority is the other half. That brings us to our next section, the shadowing technique, focusing on building prosody and automaticity. Shadowing is a linguistic echoing mechanism, and it is incredibly effective. Basically, you listen to the rhythm and stress of an expert speaker, you copy their flow, and you repeat the phrase out loud. Over time, this builds what we call linguistic automaticity. By echoing this kind of speech, you're developing the prosodic features, the natural rhythm, the intonation, that confident tone, all without that awkward hesitation of trying to translate thoughts in your head first. Let's move into our executive-level shadowing practice. Think of this as an interactive training montage. I'm going to break the fourth wall here and ask you to actually speak out loud wherever you're watching this. I'll say a phrase, pause, and then repeat it exactly. In that pause, and then right along with me the second time, I want you to shadow my voice. Ready? Let's go. Here's our first phrase. Listen to the cadence and echo it out loud. The data indicates a strong return. The data indicates a strong return. Great job! Let's do the next one. Really listen for the stress on the key business metrics. And repeat. Profit per dollar of sales is shrinking. Profit per dollar of sales is shrinking. Fantastic. Okay, let's do one more to really lock in that authoritative executive tone. Repeat after me. This strategy is capital accretive. This strategy is capital accretive. Excellent. And look, I want to reassure you, just 5 minutes of practice like this creates real, lasting habits. You don't need to sit there studying for hours a day. Brief daily shadowing practice builds that automaticity. It literally trains your mouth, your breath, and your mind to sound completely natural and confident for those high-stakes moments. So, the crucial point is, driving decisions with confidence is your ultimate differentiator. It's the exact thing that transforms a mid-level analyst into a highly influential, strategic finance leader. And this applies to literally everything you do, even the incredibly dense technical subjects like WACC, the weighted average cost of capital. Calculating the cost of debt and equity is highly subjective, right? So when you're sitting across the table from an auditor defending your fair value reporting, you can't just throw a spreadsheet at them. You have to craft a transparent, structured story that clearly justifies your inputs. The narrative is every bit as important as the math itself. Which brings us to our final provocative thought for this explainer. I want you to ask yourself, are you ready to stop just reporting the numbers and start actually steering the company towards sustained success? Because you have the tools now. You've got the dual iterative framework, the plain language analogies, the bluff structure, and the shadowing technique. It's time to step up to the executive table and make your voice heard. Thanks so much for joining me today, and keep practicing.
Okay, let's dive into this explainer and expose a massive hidden trap in your FMNPV questions.
Are you constantly bleeding easy exam marks on net present value calculations? Well, let's fix that right now.
The ultimate rookie mistake is completely ignoring working capital recovery. Literally, it'll just destroy your final score.
So what is working capital? Think of it as your baseline setup, inventory and receivables minus your payables. It's a life cycle. Your cash gets totally tied up during the project, and then eventually it's released. Which brings us to the golden NPV rule. You deduct at the start and recover at the end.
Step 1 is crucial. You absolutely must deduct that initial working capital as a massive cash outflow.
But here's the trap. When the project wraps, you've got to remember to recover those funds as cash inflows.
As Rohan's notes perfectly summarize, true NPV cash flows always got to explicitly include both tax and working capital.
So apply this exact fix. Releasing that capital as an inflow at the end is a guaranteed mark saver.
Are you ready to dodge this trap completely and finally pass your FM exam with total confidence?
You honestly need Rohan's complete FM exam notes. They're packed with high-yield summaries that expose every sneaky trap. Grab those paid FM notes today. Because seriously, how many other hidden traps are secretly draining your score?
Welcome to this explainer on the budget cut and moving from panic to partnership in FP&A. So today we're diving straight into a scenario that honestly brings a profound sense of dread to pretty much every finance professional out there. You know the feeling, right? You're sitting there holding a broken, red ink-stained spreadsheet. You absolutely know the numbers are bad, and then it hits you. You have to go tell a department head that their funding is getting slashed. It is, hands down, the most dreaded communication scenario in financial planning and analysis.
Okay, let's dive into this. Have your financial updates ever caused a literal panic attack? Seriously, think about it for a second. Either for you, sitting at your desk just completely dreading that upcoming meeting, or for the person across the table who just watched their strategic plans evaporate in real time. Delivering bad financial news is steeped in this immense stress and anxiety. But you know, it really doesn't have to be that way.
Because the real cost of poor FP&A communication? Well, it isn't just a spreadsheet variance. As finance professionals highlight over and over, the anxiety of the job doesn't usually come from external customers or some complex compliance requirement.
No, the real palpable stress comes from intense executive pressure, overpromising, and that deep sinking dread of hurting feelings or ruining internal stakeholder relationships when you're the one forced to deliver the bad news.
And honestly, the reality gets pretty brutal on industry forums. One professional put it perfectly, pointing out that, quote, douchey biz partners will create some stress. When finance professionals act like unyielding, strict enforcers of the budget, it completely isolates the finance team into silos. It creates this toxic friction across departments, turning what should be your collaborative colleagues into resentful adversaries.
And this brilliantly illustrates exactly what that feels like. When finance drops a harsh, completely uncontextualized 20% reduction mandate on a frustrated operations manager, it feels like a massive red stamp of cancellation on all their hard work. That is a relationship-destroying blunt cut. It literally leaves the operations team feeling attacked and defensive, instead of feeling supported and guided toward an actual solution.
In fact, this dynamic gets so toxic that people will just walk away. Another professional noted, quote, I've left before once I saw finance trying to absolutely steamroll operations. We are business partners. And that right there is a massive takeaway. As FP&A professionals, we absolutely must refuse to steamroll operations. The top priority has to be acting as collaborative business partners, not acting like the corporate police handing out speeding tickets.
So what's the fix? Well, the antidote to all this toxic friction is something called FP&A storytelling. This is the practice of turning financial insights into a clear, structured narrative that connects data directly to business decisions. It's basically the ultimate solution to bridge that massive gap between abstract numbers on a spreadsheet and the gritty operational reality of the business. It's all about giving that much-needed context to the numbers.
So the crucial point here is making a radical vocabulary shift. Look at this phrasing. Telling someone, we need to cut your OPEX by 20% just sounds like a strict, top-down penalty, right? But framing it as, let's partner to reallocate capital toward higher ROI channels completely changes the entire dynamic of the room. You're not just taking something away anymore. You are partnering with them to optimize capital allocation, pushing those resources to high ROI channels, and ultimately making the overall business stronger. It's a total game changer.
To actually pull this off effectively, we use a fantastic framework from the Corporate Finance Institute called WEFT, which stands for What's in it for them. You absolutely have to focus on stakeholder priorities. Think about it. The CFO is constantly looking at long-term growth and capital allocation. Sales? Well, they care deeply about how changes are going to affect their hard-earned incentive plans and quotas. And operations is zeroing in on capacity and simply keeping the lights on. Matching your message to their specific, day-to-day reality creates instant engagement and builds incredible credibility.
But to make this work, we have to remember that executives and non-finance teams usually just tune out technical jargon. So instead of throwing around heavy terms like OPEX optimization and EBITDA margin compression, try translating that into plain, everyday language. Try saying something like, we are making day-to-day operations efficient as profit per sales dollar shrinks. We absolutely must translate our terms to ensure everyone across all levels of the organization actually comprehends what we're saying.
Okay, so once you have their attention and they actually understand the situation, you need to drive action. Narrative storytelling has to lead to decisions. So here is a highly actionable framework called the 1-3-1 method. It goes like this. First, start with the one question you're trying to answer. Next, present 3 viable options or considerations. And finally, end with one clear recommendation. This framework cuts right through decision fatigue and lets you confidently deliver your capital reallocation plans without ever sounding vague or indecisive.
Now, as you can see, there is a stark contrast between the old way of working and the new. Historically, Stage 1 reporters were kind of stuck. They were always looking backward at historical variances, relying on siloed budgets, and really just reacting after the results were already known. But the modern FP&A professional, they are a value creator. They're anticipating risks using integrated business planning and connecting high-level strategy directly to daily execution. It's a completely different, totally forward-looking mindset.
The reality is, FP&A is standing at a major turning point. We literally can no longer afford to plan in isolation. We have to connect revenue, costs, capacity, and headcount into one cohesive decision framework. By embracing this integration and replacing those blunt, relationship-destroying cuts with strategic storytelling, finance professionals stop being just back-office reporters and become truly indispensable strategic advisors. Which leaves us with a powerful new way to frame our most difficult conversations. Instead of walking into a room and just asking, where can we cut? I want to challenge you to ask this instead. If we reallocate your capital today, what breaks and what grows? Take that collaborative question into your next budget meeting and just watch how it transforms conflict into a true strategic partnership.
Welcome to The Explainer. Let's turn complex financial research into actionable communication strategies for FP&A pros.
So how exactly do you deliver tough financial news without instantly starting a turf war? Presenting bad news causes universal anxiety. Just look at the senior analysts sharing their pure dread on Reddit. The root cause? Wisdom shows we spend 75% of our time buried in data, neglecting soft skills. Stop saying you're cutting your budget. Instead, say you're partnering to optimize capital allocation toward high ROI channels. To really make that shift, use the WIFT technique. Frame insights around the specific goals they actually value. Ditch the abstract accounting jargon. You've got to use plain, business-focused analogies that absolutely everyone gets right away. Presenting to busy executives? Always use the bluff method. State your main recommendation before dumping the background data. Structure this using the rule of 3. Give them a headline, 3 supporting drivers, and a clear recommendation. You're on the right track with healthy eating. Here's how to keep it fast and efficient. 1. Jump right in. Health eating is more than just choosing broccoli over pizza. It's about fueling your body with the right nutrients, giving it everything it needs to work at its best. 2. Make it work with your schedule. Instead of spending hours in the gym buying portion-controlled meals, choose fit videos and recipes. Make it work for your life, and then keep it working around you all the time. 3. The right diet. Focus on nutrition. Incorporate a variety of veggies, fruits, whole foods. Don't feel the need to do a single diet. You are not living a single life. A clear recommendation is simple. Keep your food, plants, and veggies part of your meal plan steadier and more often. You won't need a diet plan. Just remember to watch portion sizes and your weight. Finally, drive action with the 1-3-1 method. Use confident, direct language like "we propose" instead of "we think." Modern FP&A pros are strategic guides. So how will you reframe your very next difficult financial conversation? Boom. This is the ultimate freedom money, literally taking over the entire world right now. Sure, Bitcoin started out as this kind of mysterious peer-to-peer digital gold, right? But hold on, we're diving straight down a totally wild, dark technical rabbit hole today. You gotta master the hardcore stuff: self-custody, UTXO distribution, and those crazy multi-sig vaults. Why? Because these complex tools are absolutely crucial to protect your own sovereign wealth. Grab my paid crypto notes to pass. So, will you finally take true digital control?